do it. We put together a really interesting market measure for today. Beth, let's have a little fun here.
As worldly as you thought you were.
No, multiple languages have never been my strength. What is the effect of delta on trade parameters? Mr. Batista, I'm going to ask you a bunch of questions today.
Oh my God.
Hopefully you'll be able to be in the correct ballpark with the answers. Let's go to the first slide. In option trading, delta is a crucial parameter used to measure the sensitivity of the option price to changes in the price of the underlying asset. The magnitude of delta indicates the degree to which an option price will move in relation to the underlying asset price movement. It's kind of, we always like to just talk about delta as just, hey, it's synthetic shares. That's all it is. So this market measures today will attempt to explain the relationship between delta and different parameters on the tastytrade platform. All right, let's go to the next slide. So we did a pretty broad study. We looked at SpyCoin, Google, Amazon, Microsoft, Tesla, Netflix, GLD, and TLT for 13 years, from 2010 to 2023. We looked at there's just a massive amount of data on here, so just play with us. 15, 20, 25, and 30 delta strangles. Average was 44 days, 45 days being our sweet spot. And for each, we calculated the theoretical statistics on POP, probability of profit, CVAR, conditional value at risk, and Theta, that is our premium decay. We compared the theoretical metrics to the realized performance over time. So we're going to look at theoretical metrics, and then we're going to actually look and see, hey, what really happened with a couple of these stocks? Let's go to the next slide. So the first one, what is the effect of delta on trade parameters? So the first thing we're going to look at and say, as delta increases, these are the various strangles, the theoretical probability of profit decreases, of course. The wider you go, the higher your pop is going to be, the narrower your strangle is. The narrower your strangle is, the lower your pop's going to be. So at 15 delta strangle, it's 72% pop, and that's because it's 15 plus 15 minus 100, which is, let's call it 70. It actually came out to 71. This is on all those underlying stocks that we looked at. And then on the 30 delta, it came down to 62.5. The change is not linear because the difference between each one wasn't exactly the same, but it's pretty damn close.
Sure.
The fact that they wrote here it's not linear is really minor. As delta increases, the pop does not decrease quite as much, but you can see right there that they're pretty much in line. Now go to the next slide. So on this slide, we looked at the same thing, the same 15, 20, 25, and 30 delta strangles. But this time we looked at CVAR and buying power reduction. Basically, CVAR being your tail risk and buying power reduction being a way to measure, how much risk you're taking. And what you see here is that as the delta increases, again, the theoretical, these are all theoretical, the theoretical tail risk of the trades increase as well. Obviously, you're going to have less risk the further out you go, and you're going to have more risk the closer you are to at the money. In this case, we wrote the change appears to be linear because each number is about $2 off the other number. Just showing you for visual purposes how efficient markets are. You move up 5 deltas, it's basically a 2% move in CVAR and buying power. You move up 5 more deltas, it's another 2% move in CVAR and buying power. That's the linear impact. Let's go to the next slide. So this one, we looked at Theta and to see how much decay. Now, obviously, you're going to have a higher decay in the more expensive strangles, and we did the visual here as well. As the delta increases, the theoretical decay increases because you're collecting bigger premium. The change appears to be approximately linear as it is. Each one drops by about $2 or 2 points. But for all 3 graphs, stocks with the lowest IVR, in this case, the SPY, GLD, and TLT, had the lowest pop, the lowest CVAR, and the lowest theta, which shouldn't surprise anybody because that's just the way the numbers work. Let's go to the next slide. So now that we have calculated the theoretical metrics of the effect of delta on pop, CVAR, and theta, let's calculate the historical realized performance of two underlyings. So we just chose SPY and Amazon between 2010 and 2023. We wanted to see if the actual realized performance based on historical numbers matched up with the theoretical expectations. So we calculate the same ratio between win rate, daily P&L, and standard deviation of P&L in this case.
I like it. They're taking it full circle.
Full circle. Yep. Let's go to the next slide. Okay, so I'm going to summarize it, but here you can see on the top the 15, 20, 25, and 30 delta strangles. And you obviously, because the SPY has a much lower implied volatility than Amazon, the SPY had a much higher win rate because lower volatility, higher win rate. The daily P&L surprisingly, well, I guess I shouldn't say surprisingly, but the daily P&L was greater in Amazon because you collected a much bigger credit and the volatility was higher. So I think that makes sense. You make more money in Amazon, you have a little bit lower win rate, you have more P&L volatility. In the SPY, you have a higher pop, you make less money, and you have a lower P&L volatility. As delta for historical strangles goes up, the percentage of winning traders goes down, the P&L goes up, and the P&L volatility goes up as well. This matches with the theoretical trends shown on slides 3 through 5. Matched up perfectly. Let's go.
Which you would hope.
Yeah. Well, yeah, it should. Right. I mean, yeah, everything we do, the theoretical should match up with historical. I mean, no, unless there's some outlier case. Mm-hmm. So what we're looking at here, which is interesting, is that delta is a fundamental Greek in option trading that helps traders to A, assess risk, B, determine potential profitability, and C, manage portfolios. It affects many parameters of the tastytrade platform or on the tastytrade platform. As delta increases, theoretical probability of profit decreases, CVAR increases, and theta increases. Let's just think about that for a second. So as delta goes up, meaning as you go from a 15 to a 20 delta strangle to a 25 delta strangle to a 30 delta strangle, okay, as the delta increases, the theoretical probability of profit is always going to decrease with the higher delta strangles. But the CVAR, because that's your tail risk, is obviously going to go up because you're selling bigger options. But your theta, that's the saving grace there, the offset, is your theta is going to increase as well, so you can make more money and make it in a shorter period of time. The lower IVR stocks, like the SPY and I forgot what the stocks were in there, the SPY and Microsoft, whatever else it was, the lower IVR stocks, they experience lower pop, lower CVAR, and lower theta. And then these theoretical changes, and here's the key, match up with the trends of historical strangles. So the percent of winners, daily P&L, and P&L volatility. So theoretical matched up with historical, when we just selected random underlyings, that is a really good thing.
Very good, sir. Good job out of you two. Good job out of team. I like that. We'll be back in 90 seconds. Even the S&P's just turned red, side enough. Volatility still down at 27 cents. Russell's still the strongest in the group. We'll be back in 90 seconds. We got more Tasty Live with, oh joy, Mr. Scott Sheridan next. This is Tasty Live.